Welcome to FM Radio, your go-to podcast for everything in the world of funds management. Whether you're an experienced advisor, a seasoned investor, or just starting your journey, we're here to break down the complex world of funds management all in a way that makes sense. Each episode, we'll talk to the experts to get their insights on everything from asset allocation to risk management and give you the inside track on how decisions are made. So tune in and let's turn up the volume on the topics that affect you and your clients. This week, we're looking at reporting season. ASX companies are reporting their results and the dividends they'll be paying. And anyone who owns shares in those companies will be looking to see if their expectations have been met. Here to unpack the reporting season for us is portfolio manager and Elston co-founder Bruce Williams. Good morning, Bruce, and welcome to the show.
Thanks, Peter. Lovely to be here.
Now, Bruce, looking at this reporting season, it always feels a bit to me like it's, school report card, those things that used to sometimes get home to my parents, except these report cards are very public. So how would you rate this reporting season overall? Is it an A plus or a C minus or something in between?
Something in between, a little bit like my report cards, could be doing better.
Could be doing better. You would have got a few D for disappointing, wouldn't you?
D for bad attitude. I think.
Can do better. I always think that's a sign of intelligence when they say can do better. They go, look, he's just lazy. He's actually really smart.
Or a missed opportunity is the other way to think.
So what did you think in terms of reporting season? Was it pretty much to expectations, do you think?
Yeah, if you're looking at it overall, I think it was actually quite good. And like most things, averages hide a lot of things. So it was quite good across the board, but there were certainly pockets of strength, pockets of weakness, pockets of challenge, pockets of opportunity. So it really varied by sector. But overall, it was quite good. Still seeing top-line revenue growth that met consensus expectations. Margins on average were a little bit better than what we were expecting. So companies are really moving forward with productivity enhancements such as the use of technology that's talked about so much these days. But certainly there were pockets of challenges as well. And a lot of that was Australian businesses with offshore earnings.
Yeah, we've chatted before about some of the variation results and companies that got punished, possibly because of some of the headwinds in their sector.
Yep.
Was there one that really stood out to you that really didn't do well as you expected?
James Hardie would be the one that really missed our expectations. And it was a function of, if you think about the US market or residential market as to how it's different from Australia. In Australia, the majority of houses here are on variable rates. Over there, when you take a mortgage, something like 95% go 30-year fixed. So it's the 30-year interest rate that is most important to them. And if you bought a house during COVID, you might be paying sub 3% for that. That interest rate's now about 7%. So if you want to either change houses, basically when you sell your house, that mortgage gets cancelled and you take out a new one. So people aren't changing houses and they aren't renovating as well, because if you look to take out more money, it's at the current rate. And, we talk about cost of living here. I was in the United States in May and I couldn't believe how expensive it was. So cost of living is probably an issue over there as well. On top of that, you have the Trump regime with their tariffs, and tariffs are a tax on the consumer ultimately. So things are likely to get more expensive. And where it came home to roost for Hardies is their primary customers in the Sunbelt states like Texas and the like are large home builders, and they're worried about the amount of houses that they're going to build looking forward, and so they destocked. Now, destocking is painful when it occurs, and we've seen this across multiple industries since COVID. Certainly Hardies is in the cyclical camp.
But on the surface it looks cyclical, but you'd probably be doing a bit more digging, a bit more analysis on James Hardie and potentially a couple of other companies.
Yeah, absolutely. Well, there are two that really come to mind. James Hardie is certainly one, and we're a lot of the way through that at the moment in terms of going back through our thesis and looking at where the issue is and how big an issue it is, how long the issue persists for, and that comes down to the market that they're in. It might be the competitors, it might be the pricing, it might be consumer preferences in terms of Hardies makes exterior cladding, and there are a few different sorts of cladding at different price points, so is there a change in consumer behaviour there? So we're most of the way through that work. The other one that we've actually finished the work on wasn't so much a weak result, it was a weaker looking guidance going forward in terms of stronger, longer term competition with CSL. And CSL is probably one of the the best businesses in the ASX over the last multiple decades.
But they'd obviously hit a bit of a crossroads. There's a bit of a restructure in terms of how they're thinking about.
Yeah, it was two things. The market was worried about their ability to win contracts to provide their services going forward, but it was a little bit of an odd one. In their main product, there's only 3 competitors globally, and one of those has financial pressures within their own business, and so they priced a contract. It was actually to the UK over 4 years at a price that CSL would not meet. And we do see this from time to time in terms of rational competition in different areas where a company just needs to get something done, even if it's for the optics, but they don't make any money out of it. And CSL's refusing to participate in that because system growth for IG, which is their main product, is still very strong. It runs at sort of 7% per annum. And so, the optics of losing that contract was not great for them. They also undertaking a bit of a streamlining of their business. The chairman feels that it's become a little bit bureaucratic, for want of a better word, in terms of their R&D function, which is massive, research and development function, had a budget, and he felt like those teams were just spending it because they had the budget.
Yeah, I'd like that to be a bit more focused. Like they're very strong on R&D, but maybe it's just got a little bit cumbersome.
Yeah, cumbersome, a lack of decision making, a lack of focus on the commerciality of the R&D function.
Becoming more focused, that could actually position them quite well going forward.
Yeah, well, I mean, it just goes to profitability in terms of your revenues growing at, say, 7% per annum or 10% per annum, whatever it is, and you can control your costs to a level lower than that. You get what's called operating leverage, which goes to a higher margin, which goes to more profitability, and you're not actually sacrificing the end product or the growth rate or anything like that. It's just efficiency. And, it's talked about a lot in Australia around productivity issues. And the benefit of productivity is essentially, another way of saying is you do more with less. It's actually not inflationary. So you can grow at higher rates and it's not inflationary. And the issue we have with productivity domestically is not so much in public companies or private enterprise for that matter. It's all in government-related services is where the issues are. So, margins during reporting season on average, so we've talked about sales, margins on average were better as well. Companies doing a very good job of being more productive, which goes to margins.
That's the indicator you're really looking to. When you see a performance indicator, it's really not about an increase in revenue or sales. It's really the margin, how well they're managing that.
Yeah, I mean, that's certainly one component because margins go to earnings, and the biggest issue we have is that basically you've got growth in top line, you've got productivity or efficiency, which goes to margins, and then you've got multiple, and they are interrelated with the amount of risk that business takes on, and that tells us what a company should trade on in terms of its multiple. And this is why we saw a lot of volatility during reporting season was because multiples are reasonably elevated. They're more elevated than they have been historically. And that comes down to, does the growth rate and the risk profile justify the multiple? And that's where we saw some really good results. The positive reaction to those results was quite muted because, one, it was expected, and two, it was priced for it. Where we saw companies get really sold off was the earnings or growth wasn't there, and it didn't have to be much of a miss. We're talking sub sort of 2% versus what was expected, or the risk to those earnings looking forward was higher, and that is that formula, which is basically growth rate and risk, determines your multiple, and they got sold off very, very heavily. And a lot of instances it might be around a short-term cyclical issue, which is what I was talking about before in terms of the difference between cyclical and structural. And so they got hammered, and that's where we got to go back and work out, was the hammering justified or was it not? And in CSL's case, we think the structural growth story is still there for CSL. Probably not as high levels as it has been historically, but it's now trading on a much, much lower multiple. So it's priced for lower. But it is an interesting dynamic where the majority of capital gain in shares over the longer term should be through earnings growth, so being more profitable on a per share basis. What we've seen in recent times is the majority of the returns have been from multiple expansion, stocks becoming more expensive, and that is not sustainable. And that's why we're always worried about what we're paying for an asset, because what you pay for is totally relevant to the return that clients generate over the longer term, investors generate over the longer term. And that's where you've got to be very, very careful in terms of, something might be in a company's favour, it's tracking along, they've had earnings growth, they've had massive multiple expansion, and then their room for error or their room for almost normalising isn't there because they miss once and they get destroyed.
The other thing you were talking about there was the forward outlook, and obviously that's to do with the fundamentals of the company, their outlook, how can they stay competitive, what's going on in the world. But there were some positives, like we're seeing a little bit of maybe, I guess, that little bit of an interest rate cut, a little bit of consumer confidence coming back. Are you picking up on that?
Oh, absolutely. We saw some really good results from, say, retailers, for example. Not so much Woolies, it was terrible, or poor, but Coles was very good. JB Hi-Fi produced another really good result. Harvey Norman, which has produced several poor results in a row, actually had quite a reasonable result as well. So what we're seeing is that it's been up for debate. We've seen a lot of federal government stimulus throughout the last 5 years, and cost of living crisis is on the news of every single day. And we're actually seeing now that wage growth that's coming through, the increasing cost side, so that's slowing down. And so you're actually getting a gap opening up between what people are earning and what it is the cost of goods they spend on. And so that bodes quite well for the Australian economy.
Yeah, and a little bit of mortgage relief doesn't hurt because it opens up their purses a bit, their wallets a bit.
Yeah, well, and more interest rates are expected over the next, again, time frame is always debatable how quickly it comes through because they had an inflation number this month that was not that good. We had an economic growth number yesterday that was higher. So, the interest rates may take a little bit longer to come through than what has been expected, but still consumers turning a little bit more positive than what they have been over the last few years.
Yeah, and Jim Chalmers has got a bit of a spring in his step. He's seen a little bit of growth in the economy.
Yeah, well, the strong economic growth number yesterday was largely government spending. So don't
don't read too much into it.
Don't lead me down that rabbit hole, Pete.
Well, if we step back then and look at more of the macro picture, I mean, it feels like a very similar story that we've been looking at for the last couple of years. What are the things that has anything changed, or is it the same mix, that sort of melting pot of Trump and Europe?
Yeah, it's interesting. I mean, Trump is a movable feast. Every week there's something different. So you had Liberation Day where he announced enormous tariffs, and then there's been this whole renegotiation process, and he has been doing that. But ultimately, tariffs are a tax on the US consumer. It makes US goods more expensive. Now, it's up to the individual company. A company like Toyota, for example, has said, well, they're going to absorb the tariff, so they won't put prices up. But not every company can or will want to do that. So that's one area of weakness we saw in our portfolio, is that we're ASX 100, the large cap portfolio, and so a lot of our bigger companies have operations globally. And you might think about not just industrials, but you might think about Macquarie Bank, Amcor, Brambles, ResMed. They all have significant US operations. And those tariffs are causing issues at the consumer level there in terms of demand. So Amcor is a good example where it provides packaging. And what they provide packaging to is consumer non-discretionary largely, which is food and healthcare products. So you'd think the demand for that is reasonably stable, but they're actually saying it's not a destocking or restocking event. The fact that they're not selling as many of these packages that they would like, it's the consumer isn't buying.
It's a little bit softer.
It's a little bit softer, and those tariffs are coming into effect now. So it'll be very interesting. Also over there, they haven't really seen much. You've got Donald Trump versus the Fed Reserve.
Yes.
Jerome Powell, so obviously not a fan. Donald Trump thinks you should be cutting very heavily. and he's not doing that, and so he's likely to get sacked later this later this year.
I think the Fed's kind of going, look, I think inflation's still a concern,
Yeah.
but obviously Trump is looking for a bit of stimulus.
I know, but the greater issue there is if you lose independence of the central bank, that is a problem, and it is a problem that the market's not priced for. The other thing is the US dollar has been strong against all comers for a long time, and so that's starting to come down, and that's a good thing. That makes the US more competitive and so on and so forth, but that's been a headwind for them as well, just the pure strength in the US dollar. So it just makes their exports less competitive globally. There's still geopolitical side of things. Obviously, you've got China there, Russia, Ukraine's there. You've got politics globally where countries, globalization is now reversing back out. So you've got greater focus on companies looking inward rather than wanting to trade globally. So that's a massive change. So there's always things. It's never a static environment, but that's certainly one area of weakness. We saw James Hardie, I mentioned before. We don't own a company called Reece. They're plumbing products with quite large operations. Again, they got hit by the same factors as James Hardie, which is the US new and renovation and remodel market in the United States for houses. There was no volume growth for Brambles in terms of they shift stuff around on pallets. Amcor, again, lack of volume growth. So you're just seeing a bit of softness in global cyclicals.
Yeah, so you see a little bit of the B's and the C's on the report card for those guys.
Yep.
What about the other end? Anyone get a gold star going back to the report card?
Yeah, well, there were quite a few actually. We had a lot of positive performers, and probably different area again. Seek was very good for us. Again, a platform business around employment. Again, they're not just Australia, they're overseas as well, and that was a very good result. Executing well, much cleaner set of financials, which makes it easier for people like us to actually interpret what it is they're doing. Good cost control. We saw an excellent result from car sales. Again, car sales, boat sales. Again, a very dominant business domestically, but they've got growth engines in Asia and South America and now the US as well, where they have a large business based around RVs, motorbikes. RVs you think is a niche, but in the US it's not. But that did a lot better than expected. They're developing more of a boat sales type of site over there. That's they're massively bullish about, and probably out of all the companies, they seem to be the most excited about their forward growth opportunities.
Okay.
And one thing we do like about them, and it's something we focus a lot on, is they're very conscious as to how their customers are travelling. And so when they talk about price increases, they want it to be directly related to value that they're providing, as opposed to just we have a very strong market position and we're just going to jam price rises through because we can. Yeah. So we think that's a lot more sustainable way to do it. It might not be as profitable, but we think it's more sustainable from a company perspective. AMP's was a very good result. It's been probably the strongest performer in the portfolio this financial year so far. We also saw good results from Brambles operationally, was absolutely excellent. Even though they're not getting too much price and they're not getting too much volume, operationally it was outstanding. In terms of productivity costs, they're looking at their model to get paid more on value add that they provide their customers, which always makes sense. The ANZ had quite a good result. It's been all about CBA for the last 2 years.
Yes.
It is by far and away the largest company on the index, and the other banks have sort of been left behind a little bit. But it was quite a good result. Worley's, which provides engineering services. So if you think about traditional hydrocarbons, traditional oil, then energy transition and renewable energy, they're an engineering company that provides services to those three segments as well as chemicals and resources. But it wasn't a good result, wasn't expected there because of, again, their market is quite difficult. Donald Trump has cancelled the Carbon Inflation Reduction Act, which is essentially the subsidisation for renewables in the US.
Yes.
And so people thought there'd be contracts cancelled left, right and centre, and that hasn't occurred, and they're just executing really well. And probably one other that was really good was Lottery Corporation, Gold Lotto. So,
really?
Yeah. So, $80 million jackpot tonight. Pete, don't tell me you don't know that's happening. So
I was aware of it. I'm not a great believer in gambling, but my wife has reminded me that there's 80 million on the line. So I think everybody in Australia is going to have a ticket in that.
Yeah, so it was a very good result around pricing and digitisation and cost control, and so we had quite a few that were really good. On the flip side of the coin, we had a few theses or a few positions that aren't working on it for us for various reasons.
I was going to say, I would think about it being there's so much information coming at you in a short amount of time, and I think the coffee consumption's probably gone up around the office because you've been consuming and analysing exactly what it all means and pulling it apart. But the work continues because there'd be a few pieces in the portfolio puzzle that you might want to go into a bit more analysis, I guess.
Yeah, and it's part of our process. So you're essentially got a month where you get 100 companies report, and you've got to turn those around reasonably quickly, and then it's a case of digesting it and looking at those that did better than you expected, those did as you expected, or those that did worse. And it's really about the ones that are doing worse is, should we still own that business? There are two components when we look at a company. There's what's called a qualitative assessment. So that's that's the industry that the company operates in and the company's position within that industry. So is it a good industry, a poor industry? Are they a strong competitor? Are they not? Do they have a competitive advantage over others? Do they not? And so that's that whole process. And we've obviously mentioned James Hardie and CSL. They were two that we've had to go back and have a look at because they underperformed our thesis. There are a couple others as well. One was Ramsay Healthcare and the other one was Endeavour Group. And again, for different reasons, but we will need to go back and look at those and go, do we still want to own those companies? Because ultimately investing, it's all relative. So, if we own a company that's underperforming, we can't see a route to it becoming performing. And there's something we've done the work on that is not in the portfolio that represents either a greater expected return or the same expected return with a lower level of risk, or it provides some other portfolio benefit that we should be putting into the portfolio at the expense of the one that's not. So we'll get through that work pretty quickly. And again, we've got to then go back and look at the portfolio and go, okay, how's it positioned? What's it exposed to? Are we happy with that? Position sizes, so each security, it might be in the portfolio from anywhere from 1.5% up to 6.5% within the portfolio. Are we comfortable with that? Does it deserve either less weighting or more weighting, and how's that changed the structure of the portfolio? So there's a whole probably month of work post, which is just a result of reporting season.
And as you said, that's part of the Elston process, and it's a team, a fairly flat structured team as well.
Yep, absolutely. Yeah. So there are four, decision makers, portfolio managers for that. We require 3 of the 4 to get a decision through on the buy side, and then helping us, we've got analysts, and so the analysts, they do a lot of the background work, a lot of the grunt work, and come to us with our recommendations as well. They do a lot of they're researchers essentially. So if you think about James Hardie, it's what exactly was failing them in that earnings result, and it turned out to be large home builders, Sunbelt states in the US, and destocking. And so, then it was a case of looking at all the competitors and going, are they losing market share as well? And so it's not only looking at Hardies, it's looking at the industry, the major players in the industry, where they can win, growth opportunities for them. So they recently did a deal with a company called ASEC, and that gives them exposure to states in the northeast, for example, that aren't in the Sunbelt, that aren't suffering the same headwinds. So, they're indispensable to us. They're fantastic.
Thanks, Bruce. It's been a great discussion about reporting season. I always love this time of year. I know you guys probably working very, very hard, maybe not enjoy it as much as everybody else.
Well, we enjoy it on the good days and we don't enjoy it on the bad days. So.
Well, thank you very much for your time. It's great that you took time out to chat to us, and I know people will really appreciate the insights on reporting season. So thank you.
Thank you, Pete. Lovely to be here.
That's all for this episode of FM Radio. We hope you can join us again soon as we tune into another aspect of funds management that affects you and your clients. FM Radio was recorded at Elston House. It was hosted by Peter Goodall And today's guest was portfolio manager Bruce Williams. For more FM radio episodes and full transcripts of the interviews, visit elston.com.au. And if you'd like to subscribe to our podcast series to make sure you don't miss a thing, you'll find FM radio on all your favourite platforms, including Spotify and Apple Podcasts. The information provided in this podcast is general in nature. You must consider your own circumstances prior to making any investment decision. For more information, go to elston.com.au or speak to your financial advisor. Elston Asset Management is authorised by EP Financial Services, AFSL number 325252.